Welcome to this episode of Mic'd Up. I'm Pete Seyler, a member of our business development team here at iCM. Today, I'm going to be joined by Mike Paciotti, iCM's Chief Investment Officer. Mike, it's great to spend some time with you here. Thanks for joining me.
Glad to be here.
So let's jump right in. We're coming to the end of 2023, and as we've been talking to a lot of advisors, they're really curious about our outlook for 2024, specifically the top three things on the investment team's radar as we look ahead to the new year.
Yeah, so inherently there's quite a bit of randomness that occurs in short-term predictions, driven by things that really tend to kind of wash themselves out over longer periods. So these are things like geopolitical events, unforeseen crisis, or even a slight shift in the pace of something known, like the decelerating economy that we're experiencing now. So these make short-term predictions less reliable than longer-term predictions, but I think there are a few things that we have a fairly high conviction in for 2024. So thematically, we believe that 2024 is going to bring a slower economy, lower short-term rates, but more specifically than that, a change in the shape of the yield curve, and a broadly weaker U.S. dollar. So now each one of these things are related to one another, meaning that if you get one, the slowing economy, for example, you're likely to kind of get the others.
All right. So does that mean that you see a recession on the horizon?
Yeah, it doesn't have to be a bad one, but I would say yes. We see it as pretty likely, mainly because of two factors. The first being that labor markets have been tight, even as the labor force now exceeds prior peaks in terms of total size. And really, if we're employing more people and producing more goods, this isn't a supply-related issue. We're just out-consuming our productive abilities. So to bring inflation fully into line with Fed expectations, the pressure on wages from tight labor markets really needs to subside, and that would require some slack in labor markets, which is only kind of just beginning.
Kind of like the JOLTS data.
Yeah, exactly. So if we look at the JOLTS data from just a week ago, we're seeing really the lowest number of job openings and the lowest quit rate that we've seen in really more than 2 years.
So stop for a second and talk to us a little bit about, why do you see that as relevant?
Well, because you usually see workers hang on to jobs when opportunities become scarcer. So for example, the peak there was about 2 jobs available for every job seeker. So now there's only about 1.3 jobs available per job seeker. Still strong, but ultimately fading.
Sure. All right. So I don't want to change gears completely, but I kind of do. I've heard you guys talk a lot about housing. Where does that fall in here? What is that, its role?
Yeah, that's actually the second factor, the second part of this. So we've recently started to see housing prices decline from peak levels. But overall housing prices relative to the level of interest rates, and really more importantly, relative to median income that supports buying a house, are actually still quite high. So you want to think about a simple way to illustrate the affordability issue is to look at the monthly mortgage payment on a median home in the U.S. So right now, that figure's around $2,600 a month. At the end of 2020, that number was less than $1,300 a month. So, but it isn't related to strength in the housing market per se, as much as it's related to sick internals.
So what you're really saying is you mean limited supply?
Yeah, exactly. So supply is limited because homeowners with low mortgages can't ultimately sell because it would be too costly to replace the exact same home at a higher mortgage rate. So you can't really ultimately end up with a strong economy without this churn, right? So houses need to change hands. Banks need to write mortgages. Contractors need to build and fix these houses. All of this is ultimately captured as someone else's wages or earnings, which is booked into our current year economic output and really recirculated into spending on other goods and services. And ultimately, if it doesn't happen, it's just a big headwind to the economy because it just touches too many things.
All right. So from what you've outlined, what does well in that environment?
Yeah, I think there are a few things. The irony here is that we're recording this on Fed Day. So what I'm going to say is actually happening today and may continue to happen before next year. But I think bonds in general will do well. In fact, that's our highest conviction idea for a single year like 2024. So the higher the quality, the better. You don't really want to reach for economically sensitive segments. Short-term treasuries will do just fine because simple stability in rates is going to allow you to clip coupons of around 5%. And with just a little bit of a downward movement in rates, you kind of end up in that 5 to 7% return range, recognizing, of course, that we may actually be harvesting some of that between now and year end. The second thing that I would ultimately give you is given the relationshap between rates and currency, we see non-dollar assets having that tailwind coming into next year of an ultimately weaker US dollar. So while there's several things that we have a high conviction in longer term, the spirit of the question was 2024. So for that, I would ultimately lean again to non-dollar denominated bonds over equities for 1 year only, just because it's pretty uncertain what the global economy will do to equities next year. And then ultimately, the final thing I'd probably leave you with, I'm going to beg a little wiggle room here. We love closed-end funds. The universe as a whole is trading at a discount of around 9% below net asset value, which is double the long-term average. And you have some segments like muni bonds trading as cheap as 12% below net asset value. So from these levels, future returns are typically very good, but that's over 2-year periods. So if I could, kind of beg a lifeline and perhaps phone a friend here, I'm gonna say closed-end funds are very attractive, but you might need to give them the benefit of just a bit longer time frame than just 2024.
So talk a little bit about that for a second. Why is that?
Well, ultimately, if you have attractive discounts and yields are upper single digits, if not double digits, rates falling would certainly benefit them. But, as I mentioned, they're a bit economically sensitive. So if we get a soft landing, I think they'll do just fine next year and the year after that. In the hard landing scenario, you might see them get a bit cheaper next year before having a banner year in like 2025.
Fair. So last thing, and Mike, I'm going to put you on the spot here a little bit. Of the 3 items that you listed, which one's your favorite?
Closed-end funds. So with just a little bit of runway beyond 2024, returns generated from these price levels have been very good historically. So yields are, ultimately the most quantifiable thing that we see, and they're upper single digits. So if you just compound those, you'd be pretty happy. So that actually might be the single best pick that I would offer for this year. I'm just kind of hedging a little bit because of the economic uncertainty.
Completely fair. Thanks, Mike. As always, great info. I appreciate you being here today.
Glad to do it.
So we at iCM appreciate the views that the Mic'd Up series has received over the last year and look forward to bringing you more great content in 2024. If you'd like to suggest a topic, have any questions, or would like to learn more about iCM's strategies, please contact us 888-426-4689 or via email at info@icm-invest.com. Thanks.